Imagine a giant, well-respected company decides to get rid of a small, unloved division. To do this, they give shares of this new independent company to all their existing shareholders for free. What happens next? Giant mutual funds and indexes that own the parent company are now stuck with shares of a tiny, unknown business they're not allowed to hold, so they sell. They all sell at once, not because the new business is bad, but because their rules force them to. The stock price tanks. That moment of forced, indiscriminate selling is where you, the individual investor, can swoop in and find incredible bargains. This is the world of special situation investing, and it's the core idea behind Joel Greenblatt's classic book, You Can Be a Stock Market Genius. Forget trying to predict the next big thing. Greenblatt argues that the real money is made by looking in the weird, messy, and boring corners of the market that Wall Street professionals avoid. The book gives you a treasure map to three main areas ripe with opportunity. First, the incredible world of spin-offs. Second, unique situations like mergers and rights offerings. And third, the surprising value hidden in bankruptcies and restructurings. Let's start with Greenblatt's favorite hunting ground, spin-offs. As we just mentioned, these situations are fantastic because they create a wave of selling that has nothing to do with the new company's actual value. There are two other hidden benefits. One, the management of the newly independent company is finally in control of their own destiny. They're usually given huge stock option packages, making them incredibly motivated to succeed. Two, these new companies are often completely ignored by Wall Street analysts, meaning if you do your homework, you can know more about the company than almost anyone else. It's a powerful combination of motivated insiders and an ignored stock. Next, Greenblatt explores other special situations where the rules of the game are different. Take merger arbitrage. This isn't about gambling on takeover rumors. It's about waiting until a merger has already been announced and then calculating your odds. If a big company agrees to buy a smaller one for $10 a share, and the stock is trading at $9.50 a share, you can buy the stock and pocket that 50-cent difference when the deal closes. Your job isn't to be a fortune teller. It's to be an insurance analyst, figuring out the small risk that the deal might fall through. Do this right, and you can earn safe, steady returns that have nothing to do with whether the market goes up or down. Finally, and this might sound crazy, Greenblatt tells you to look at bankruptcies. The key is not to buy a company on its way into bankruptcy, but to look for it on its way out. When a company reorganizes under Chapter 11, the old stock is often wiped out. The company's lenders usually get shares in the new, restructured company. The result? A business that is suddenly free of debt, leaner, and ready to compete. But because of the stigma of the word bankruptcy, these new shares often trade at absurdly low prices, giving you a chance to buy into a healthy company for pennies on the dollar. In the end, You Can Be a Stock Market Genius is a guide to playing a different game. It's not about being smarter than Wall Street. It's about fishing in ponds they can't access. The key takeaway is this. Look for situations where other investors are forced to sell for reasons unrelated to a company's value. As Greenblatt says, you're looking for a special situation where the odds are so greatly in your favor that you can't lose. If you enjoyed this approach, you might also like Greenblatt's other book, The Little Book That Still Beats the Market for a Simpler Formula, or The Most Important Thing by Howard Marks for a masterclass in thinking about risk. Find more great summaries and reading guides at booksplat.com. Level up yourself today, 3 minutes at a time.